Every week, HMRC pays you money. Not a lot, just enough that you stop thinking about it. Then January arrives. You open your tax return and discover they want it back. That is the child benefit trap. And it is catching families who earn between £60,000 and £100,000 every single year. Not because they've done anything wrong, because they received a benefit they were entitled to, didn't realize they'd have to pay it back, and by the time the charge arrives, the tax year is already closed. There is nothing you can do at that point, but there is something you can do right now. My name is Mark. Welcome to Wealth Architecture. Let me explain exactly what happened to the person in that scenario. Child benefit is a government payment made to families with children under 16, or under 20 if they're in approved education or training. For 2026/27, it's £27.05 per week for the first child and £17.90 for each additional child. That is over £1,400 a year for one child, over £2,300 for two. The high-income child benefit charge claws this back once the higher earner in a household has adjusted net income above £60,000. High-income child benefit charge 2026/27. Below £60,000, ANI, no charge, full child benefit retained. £60,000 to £80,000, 1% charge per £200 above £60,000. Above £80,000, full clawback, zero net benefit retained. For a family with two children, the combined child benefit is worth approximately £2,337 per year. Losing that across a £20,000 income band creates an effective marginal rate of around 51% in that band. For three children, higher. Four, higher still. But the mechanism that makes this a trap, rather than just a policy, is the timing. And we are going to look at that now. The trap works because the pain comes later. You receive the benefit in weekly increments. £27 here, £17 there. It lands in your account. You stop thinking about it because it's small and it's regular and it's unremarkable. Then January comes. You're filling in your self-assessment and there it is, a charge. For money HMRC paid you, in a year that has now closed. You cannot go back and restructure your income. You cannot undo the benefit payments. The year is over. This is not carelessness. It is a completely predictable human response to a system that puts the reward before the cost. The weekly payment feels real and present. The annual charge feels like punishment arriving from nowhere. The way to avoid this is not to refuse the benefit. The way to avoid it is to reduce your adjusted net income before the charge applies. Same tool as the personal allowance taper. Pension contributions. If your adjusted net income is £72,000 and you have two children, you are losing approximately £1,400 of child benefit per year to the charge. A pension contribution of £12,000 brings your adjusted net income to £60,000 and restores the full benefit. At 40% relief, the £12,000 contribution costs £7,200 net. The child benefit restored is worth £2,337 per year. The actual net cost of the contribution, once the restored benefit is counted, approximately £4,900. Under £5,000 net for a £12,000 pension contribution, that also restores over £2,300 in annual benefit. The pension doesn't just protect your tax position. For families, it can restore benefits you thought were permanently gone. One decision, multiple effects. That is what financial structure means. I want to be direct about why this video exists. The child benefit trap is not explained on channels aimed at very high earners. Because it starts at 60,000, which is below their audience. It is not explained on general personal finance channels because they rarely go deep enough to show the pension interaction. That gap is exactly where this channel lives. If this video reaches one family who acts on it, it has done its job. If it reaches thousands, that is the channel working as it should. Send it to someone with children earning between 60 and 100,000. They may not know this exists, and it could be worth thousands to them every year for as long as their children are eligible. 3 things to do if this applies to you. 1. Confirm whether you're currently claiming child benefit. If you stopped when your income crossed 60,000 and your adjusted net income has since been reduced through pension contributions, you may now be eligible to restart. You cannot backdate a claim. Act now. 2. Calculate the pension contribution that would bring your adjusted net income below 60,000. Then calculate the child benefit you'd restore. Include that benefit when assessing the contribution's real net cost. The actual number is almost always significantly better than the headline figure. 3. If your income has been above 80,000 for several years and you've been paying the full charge, confirm it is correctly declared on your self-assessment returns. Undeclared charges carry penalties. Child benefit charge action checklist. 1. Check your current ANI, not your salary. 2. If above £60,000, calculate the charge you owe this year. 3. If pension contributions can bring you below £60,000, calculate the saving. 4. If you stopped claiming, restructure first, then restart the claim. 5. Ensure the charge is declared on self-assessment, if applicable. In the next video, a question that follows from this one: when does a pension stop being the most efficient vehicle? At what point have you contributed enough, or at what income level do other structures start to matter more? Most people never ask this question, and the answer changes how you think about the rest of your financial life. Send this video to someone with children who earns between 60,000 and 100,000. They may not know this exists, and it could be worth thousands to them every single year. Subscribe. See you in the next one.